Hello, everyone, and welcome back to Insights Beats. Today, we're diving deep into the world of finance to explore some complex financial instruments and scams that may not be illegal but can be incredibly tricky for the average person to understand, potentially leading to financial losses. These instruments often involve legal complexities and risks that might not be immediately apparent, leaving many individuals vulnerable to financial loss. Let's explore several of them. First up, we have binary options trading. It's a form of financial betting where you predict whether an asset's price will go up or down within a specified timeframe. While binary options are not inherently illegal, they are often perceived as scams due to several reasons. The challenges associated with binary options are many-fold. First is complexity. Binary options may appear simple, but they involve predicting price movements within a very short time frame, often just minutes. This complexity can confuse and mislead inexperienced traders. Second is lack of regulation. Binary options are often traded on unregulated platforms, leaving investors with little recourse if something goes wrong. Without proper oversight, these platforms may engage in fraudulent practices. Another challenge is the promise of quick profits. Unscrupulous binary options brokers lure investors with promises of quick, high returns, often claiming that you can double or triple your investment in a matter of minutes. And last but not the least is rigged platforms. In some cases, binary options platforms manipulate the trading environment to ensure that traders lose more often than they win. This makes it seem like the odds are stacked against the investor. In India, investors were lured into binary options schemes, such as the IQ option platform, promising substantial returns. However, many individuals ended up losing their entire investments due to unfavorable market conditions and the platform's complexities. So, when it comes to binary options trading, it's crucial to exercise extreme caution. Always choose regulated platforms, conduct thorough research, and be wary of promises that seem too good to be true. Remember, while binary options may not be inherently illegal, the risks associated with them can be incredibly high. Next, let's talk about ICOs in the cryptocurrency world. ICOs are a method for new cryptocurrency projects to raise capital from the public. They have gained significant attention, but not all ICOs are created equal. Let's break down how they work. In an ICO, a cryptocurrency project offers a new digital token or coin for sale to the public. Investors can purchase these tokens using existing cryptocurrencies like Bitcoin or Ethereum or even fiat currencies. The funds raised through the ICO are typically used to develop the project, build the underlying technology, and bring the cryptocurrency to market. Investors in ICOs often expect that the value of the new token will increase once it's listed on cryptocurrency exchanges, potentially leading to substantial profits. So, what are the benefits of an ICO? First is that an ICO provides access to capital. ICOs provide a decentralized way for startups and cryptocurrency projects to access capital without relying on traditional financial institutions. Then is global reach. ICOs can attract investors from around the world, making it easier for projects to gain a global user base and funding. And finally, innovation. ICOs have played a role in funding innovative blockchain projects and new cryptocurrency ecosystems. But, in spite of its benefits, there are a lot of challenges associated with ICOs, especially the fraudulent ones. One of the primary challenges with ICOs is the lack of regulatory oversight. This means that anyone can launch an ICO without the same level of scrutiny that traditional financial offerings receive. The absence of regulation has allowed fraudulent actors to create fake ICOs, promising impressive returns but disappearing with investors' funds. This has led to a proliferation of scams and fraudulent projects. Some ICOs make unrealistic promises, such as guaranteed profits or exaggerated claims about the project's potential. Investors who believe these promises can end up losing money. An unfortunate example of a fraudulent ICO in India is the Gain Bitcoin scam. This scheme was promoted as a cloud-based cryptocurrency mining operation, promising guaranteed returns on investments in Bitcoin mining. The Gain Bitcoin scam serves as a stark reminder of the risks associated with fraudulent ICOs and the importance of conducting due diligence before investing in any cryptocurrency project. The third type of scam is one which involves forex trading. Forex trading, also known as foreign exchange trading, is the global marketplace for buying and selling currencies. It's one of the largest and most liquid financial markets in the world. So, how does forex trading work? In forex trading, currencies are traded in pairs, such as euro to US dollar. You buy one currency while simultaneously selling another, hoping to profit from the exchange rate fluctuations. Forex trading often involves the use of leverage, which allows traders to control larger positions with a relatively small amount of capital. Leverage can amplify both gains and losses. The Forex market operates 24 hours a day, 5 days a week, due to its decentralized nature and the involvement of major financial centers worldwide. It has its own benefits. Forex is highly liquid, meaning you can enter or exit positions easily. This liquidity reduces the risk of being unable to execute trades. With numerous currency pairs and the ability to trade both rising and falling markets, Forex offers diverse trading opportunities. Forex trading is also accessible to retail traders, allowing them to participate in a global market traditionally dominated by financial institutions. However, there are many challenges and risks involved with Forex trading. High leverage allows traders to control more significant positions than their initial capital, but it also amplifies losses. A small adverse price movement can result in substantial losses. When trading with high leverage, traders must maintain a minimum account balance, known as margin. If losses exceed this amount, the broker may issue a margin call, requiring additional funds to cover losses. The potential for large gains and losses in a short time frame can lead to emotional stress, impulsive decisions, and overtrading. Example: the Rajvinder Forex scam duped investors by promising guaranteed returns in the Forex market. The unscrupulous operators engaged in unauthorized Forex trading, resulting in massive losses for investors. Number 4 is penny stocks, or as I like to call them, greed stocks. Penny stocks, also known as microcap stocks, are low-priced stocks that typically trade for single-digit rupee per share. While they may seem like an opportunity to strike gold, they come with a unique set of risks, including the notorious pump and dump schemes. Let's explore these risks in detail. Penny stocks often have limited public information available, making it challenging for investors to conduct thorough research. The absence of reliable data can lead to uninformed investment decisions. Due to their low share prices and limited market capitalization, penny stocks are highly volatile. Prices can skyrocket or plummet dramatically in a short period, leading to substantial gains or losses. Penny stocks may lack liquidity, making it difficult to buy or sell shares at desired prices. This can result in investors being unable to exit positions quickly. These types of stocks are also susceptible to manipulation by unscrupulous individuals and groups. This manipulation can artificially inflate share prices and create a false sense of demand. Now, let's discuss the unethical practice of pump and dump schemes, which is prevalent in the world of penny stocks. Pump and dump schemes work in the following way. Fraudsters acquire a significant number of shares of a particular penny stock at a low price. They then aggressively promote the stock through various means, including social media, email, and fake news releases. The promotion creates a buzz around the stock, attracting unsuspecting investors who start buying shares. As demand increases, the stock's price rises rapidly. Once the price reaches a peak, the fraudsters sell off their shares at the inflated price, reaping substantial profits. This mass selling causes the stock's price to plummet. Example: the Speak Asia scam in India revolved around penny stocks, where the company promised lucrative returns for participating in surveys. However, it was exposed as a fraudulent pyramid scheme, causing significant financial losses for participants. The fifth type of financial fraud in my list is chit funds. Chit funds, also known as chit schemes or chitty, are a unique financial arrangement that has been popular in India for decades. They offer a method for people to save and borrow money within a community. However, like any financial instrument, they come with their own set of benefits and risks. To understand chit funds, let's first understand how they work. A chit fund is typically formed by a group of individuals, friends, or community members who agree to pool a fixed amount of money periodically, usually monthly. This forms the chit or kitty. Each month, the members participate in an auction where they bid for the total pool of money. The highest bidder wins the pool, minus a predetermined commission paid to the chit fund company or organizer. After the auction, the winning member continues to contribute to the pool but is ineligible to win it again. The process continues until each member has had a chance to receive the pool money. Chit funds have their own benefits which may, at times, overshadow the risks associated with them. They serve as a dual-purpose financial instrument. Members can save money systematically, and they can also borrow from the pool when they win an auction, making it a source of funds for various needs. Chit funds are often accessible to people who may not have access to traditional banking services, making it a financial inclusion tool. They also foster a sense of community and trust among members, as they often involve people from the same neighborhood or social group. However, as I shared earlier, the risks and challenges associated with a chit fund may get overshadowed by the benefits, but it's important to be cognizant of them. Not all chit funds are regulated, which opens the door for unscrupulous individuals to create fraudulent schemes. Unregulated chit funds may not adhere to financial laws and may not protect the interests of members. Some fraudulent chit funds promise high returns to lure in unsuspecting investors. These promises can be unrealistic and are often unsustainable in the long run.
In some cases, chit fund organizers may mismanage funds or divert them for personal use, leading to financial losses for members.
Example: the Sardau Group chit fund scam in India saw thousands of investors losing their savings. The company collected money promising high returns but diverted funds into other businesses, leading to its eventual collapse and financial ruin for investors. Next up is offshore investments. Offshore investments, often touted as a means to minimize taxes and diversify assets, have gained popularity among investors. However, these investments come with their own set of legal and financial risks that need careful consideration. Let's delve into them. Offshore financial centers and tax havens often have less stringent regulatory oversight compared to major financial markets. This can lead to reduced investor protection and transparency. While offshore investments can legally minimize taxes through legitimate structures, they can also be misused for tax evasion. Engaging in illegal tax evasion schemes can result in severe legal consequences, including hefty fines and criminal charges. Tax laws and regulations in offshore jurisdictions can change, potentially affecting the legality and tax implications of your investments. Staying compliant with evolving regulations can be challenging. There are a host of financial risks associated with offshore investments. Offshore investments often involve dealing with multiple currencies. Fluctuations in exchange rates can significantly impact the value of your investments. These investments may provide limited access to financial information, making it challenging to perform due diligence and assess the true financial health of an investment. Some offshore investment vehicles may have hidden fees and costs, eroding your returns over time. Understanding the fee structure is crucial. Example: the Panama Papers leak revealed how offshore accounts were used by many Indian individuals and entities to evade taxes. While not illegal in all cases, the lack of transparency raised concerns and led to investigations into possible financial misconduct. The seventh and next financial scam is peer-to-peer lending. Peer-to-peer or P2P lending is a financial innovation that has disrupted the traditional lending landscape. It connects borrowers directly with individual investors, offering both opportunities and challenges. P2P lending platforms act as intermediaries, bringing together borrowers and investors. Borrowers create loan listings, specifying the amount they need and the interest rate they're willing to pay. Investors, often individuals seeking to earn interest, review loan listings and choose which ones to fund. They can diversify their investments across multiple loans to spread risk. Borrowers repay the loans, including principal and interest, over a predefined period. The P2P platform facilitates the collection of repayments and distributes them to investors. P2P lending does have its own benefits. It provides an alternative source of financing for borrowers who may not meet traditional lending criteria. It also offers an avenue for individuals to invest and potentially earn higher returns than traditional savings. Investors can diversify their portfolios by participating in multiple loans, spreading risk across different borrowers and loan types. Many P2P platforms provide transparent information about borrowers, including their credit history and purpose for the loan, allowing investors to make informed decisions. However, it's the risks associated with fraudulent P2P platforms that makes it a risky bet. Not all P2P lending platforms are regulated, leaving room for fraudulent operators to set up fake platforms with the intention of scamming investors. Fraudulent P2P platforms may misrepresent borrower information, financial health, or risk profiles, leading investors to make poor investment decisions. Some P2P platforms operate as Ponzi schemes, using funds from new investors to repay earlier investors. This can continue until the scheme collapses, causing substantial losses. And last but not the least is the multi-level marketing, MLM, investments. Multi-level marketing, or MLM, is a business model that has been both praised and criticized. At its core, it relies on a pyramid-like structure where participants earn income not only from their sales but also from the sales of those they recruit. MLMs typically have a tiered structure where participants recruit others to join the scheme. These recruits are known as downlines. Participants earn commissions not only from their own sales but also from the sales generated by their downlines. This creates a hierarchical pyramid structure. The pyramid structure encourages endless recruitment as participants aim to build larger downlines to increase their potential earnings. As with all the financial instruments we discussed so far, the risks associated with MLM schemes warrant a lot of caution before entering into one. The pyramid structure of MLMs often leads to a saturation point where there are not enough new recruits to sustain the earnings of those at the top. This can result in financial losses for participants lower down the pyramid. MLMs can place excessive emphasis on recruitment rather than product sales. This can lead to participants feeling pressured to recruit more people, even if the products have limited value or appeal. Also, a majority of participants in MLMs may not achieve significant earnings, leading to high dropout rates. Many individuals invest time and money without achieving their financial goals. Some MLMs have faced ethical concerns, including allegations of operating as pyramid schemes or making false income claims. These practices can damage the reputation of the entire MLM industry. Example, the QNet MLM scam in India attracted investors by selling wellness products while promising substantial returns. However, the business model relied heavily on recruitment, and many participants ended up losing their investments when the scheme collapsed. So, there you have it, 8 complex financial instruments and scams that may not be scams in a legal sense but certainly come with risks that can lead to financial loss. It's essential to educate yourself, seek professional advice, and always remember the old saying, if it sounds too good to be true, it probably is. If you found this video informative, please give it a thumbs up and subscribe for more valuable content on financial literacy. Thanks for joining me today, and stay financially savvy.